I'm going to make this large and post it out. So I'm going to go to the receivable account here, double click on it, go to the end of it, plus, and then go to the receivable of 1/8 and enter. Now notice again we're out of balance over here because we also need to report that receivable to who owes us the money. And in this case, if we take a look at 7/19, we sold it to Art. So Art, we can also post it here, and we're going to record who owes us the money, so we tie back out as we go. Then we're going to go to the sales account. So sales is down here. Going to double click on that, say plus, go to the sales. That's going to put us back in balance and bring net income up. Then we can go to the cost of goods sold. I'm going to double click on the cost of goods sold and go to here. That's going to bring net income down. So net income goes down. Remember, net income is income minus expenses. Then merchandise inventory. I'm going to double click on that. Go to the end of it, plus, and go to the credit in merchandise inventory and enter. So now we are on 7/21, which says issue 300 credit memorandum to Art Company for an allowance for goods sold. So a credit memorandum generally means we're going to reduce the amount that the customer owes to us for the goods that we sold. Generally that's often due because they gave the merchandise back. In this case, they're not saying that any merchandise was given back, but we are reducing the amount of the receivable for some reason or another. Maybe it was damaged or something like that. So we are going to say that the amount that the company owes us, that the amount that our client owes us, is going to go down. That's represented by the receivable here. We're going to make it go down by doing the opposite thing to it, which in this case would be a credit. So we're going to credit the receivable that people owe us for, in this case, 300. Then we're going to debit something. And you might be thinking, well, we should be debiting sales because we recorded the sales when we put it on the books for receivables, and we should reduce that. But again, we don't usually reduce sales. Sales only goes one way, it goes up. We instead are going to make a contra kind of sales account, which will be called sales returns and allowances. So we're going to post it to sales returns and allowance, which is kind of like a contra sales account. Then we can post this out. So I'm going to double click on sales returns and allowances because something's in it. Go to the end of it, plus, and then go to the 300 here, bringing that up, puts us out of balance here. Then we'll go to the receivables. I'm going to double click on the receivable, go to the end of it, plus, point to the credit, and that puts us back in balance here. And the person that we sold this to is, or issued the credit memorandum to, I should say, is Art. So Art, here we're going to say that that equals the credit, reducing the amount that Art owes us to 1/5, making the total go to 1/5, which ties out to the receivable on the trial balance. So now let's move on to number 724, date 724. Paid light, the balance due after deducting the discount. Okay, so is cash affected? In this case, yes, we paid something. So cash has a debit balance. We're going to make it go down by doing the opposite thing to it, which in this case would be a credit. So we're going to credit something. I don't know exactly how much yet. We'll figure that out in a second, but I know that it's going to be a credit. We're going to have to debit something. Why are we paying something? We didn't get anything today. We got something in the past. We're paying off the payable. So the payable has a credit balance. We need to make it go down by doing the opposite thing to it, which in this case would be a debit. So we're going to debit the payable and credit cash. But once again, we have this discount that we need to look into and take care of. So on 724 says paid light, the balance due after the discount. So we can see here that we have a 2% discount again, 2% because we paid within 15 days. Let's take a look at our subsidiary ledger for light here. We can see that the original invoice was for 2.5, but then we reduced it by 500 because we returned merchandise, I believe. Therefore, the amount that is owed now is 2,000. So how much of that 2,000 we're going to pay after a 2% discount? We have 2,000 times 0.02, because we've moved the decimal over 2 places. It's 0.02, gives us $40. So if we had 2,000 and we're getting a discount of 40 minus 40, we have 1960. We can calculate that another way. We can say 100 or 100% minus 0.02. The discount means that if we're getting a 2% discount, we're paying 98%. Times the 2,000, which gives us the same 1,960. So how much are we paying? I'm going to put a negative of 2,000 times 0.98, 98%. And that gives us what we're going to pay how much do we have to take off the books for accounts payable? We got to take off the full amount that we owe. So the debit needs to be for the full $2,000 to bring it off the books there. Therefore, we have a difference. That difference being this minus this, being that $40. And we can calculate that two ways. We can say it's this minus this, or we can say it's a negative of the $2,000 times the 0.02 discount. And that's the $40. So now this plus this equals the $2,000. All of this equals 0 because the debits equal the credit. And then the question is, where does the discount go to? And in this case, because it's our purchase, that means we're reducing the inventory because we put it into inventory. We over-reported our inventory because after the discount, we didn't pay $2,000. We paid $2,000 minus the 40. We only paid the 1960. So we got to reduce this amount to bring it to the amount that we actually paid. So then we're going to post this out. I'm going to double click here, go to the end, plus, not the receivable, to the payable. Double click on the payable, go to the end, plus, and then go to the 2000 here, enter. We can also post that over here because light needs to go down. So I'm going to put that in the debit on this side. The 2000 brings the amount we owe to light down to 0, puts us back in balance here. Then we're going to go to the merchandise inventory, double click on that, go to the end, plus, and go to the merchandise inventory. And then we also need to post the cash. So I'm out of balance by cash. I'm going to go to cash, going to double click on the cash, go to the end of that, plus, and then go to the credit in cash, and that'll put us back in balance. So now we are on 7/30. Received the balance due from Art Company for the invoice dated July 19th, net of the discount. So is cash affected? And it says yes, we received cash, and cash has a debit balance. We're going to make it go up by doing the same thing to it, which in this case would be another debit. We don't know exactly what that amount is, but I know I'm going to debit it for now. And why are we going to get that cash? We didn't earn the revenue today, so we're not going to record the credit to sales now. We're going to record it instead to a reduction in the receivable because they're paying off what they owe. A receivable has a debit balance. We're going to make it go down by doing the opposite thing to it, which is a credit. Then let's think about how much that should be for. Once again, we have this 2% discount that was paid within the discount period. Here we have Art over here. And if we look at the activity, the original sale was for 1.8, but then there was a return or something of 300. So the only that was owed to us now is the 1.5. So how much are we going to receive? 1.5, and we're given a 2% discount, 0.02, $30 discount. So 1.5 minus 30 means we're going to get 1470. We can calculate that in one calculation by taking 1 minus 0.02. If we're given a 2% discount, we're getting 98% times the amount of 1.5 gives us the 1470. We'll do that one more time over here. The cash we're receiving is the 1.5 times 0.98 or the 1470. We need to take it off the books for the entire amount though, because they don't owe us anything anymore. So the 15 needs to come off the books. The difference, the 15 minus the 70 is the $30 of the discount. And so we need a debit of 30. We can do it this minus this, or we can say it's the 15 times the 0.02 discount. There's that. The debits now equal the credits. And that now will be going to, in this case, sales discount. So because this is a discount that we are giving to our customers, we had recorded the sales at 1.5. So you would think that we would reduce the sales. But what we're really going to do is we're going to create a contra account, the discount account, and put it into the discount because sales generally only goes up. So I'm going to double click on the cash. I'm going to go to the end of that and say plus and point to the cash and enter. The receivables over here, going to double click on that, go to the end of that, plus go to the credit here and enter. We can also record that receivable over here. We're going to say equals or plus the receivable, bringing the balance that is owed to us down to 0, back in balance. Then the discount here plus the 30, enter, and that puts us back in balance. Okay, so we got the last one on 7/31. Says sold merchandise that cost 5.3 to Creek Company for 7.4 under credit terms 2.10, which is a 2% discount if we get paid within 10 days. Otherwise, we get paid within 60 days, or we take collection action. shipping point. All right. So is cash affected? In this case, no, because we sold it on account. Therefore, what we got is an IOU represented by the receivable. The receivable is going to go up, and therefore receivables have a debit balance. We're going to make it go up by doing the same thing to it, which would be another debit of 7.4. We're going to credit something, and the credit is going to go to income or sales in this case. So sales has a credit balance. We're going to make it go up by doing the same thing to it, which in this case would be another credit. So we're going to credit sales, and then we have another piece of that because when we sell something, we sold merchandise. So merchandise inventory is a debit. We're going to make it go down by doing the opposite thing to it, which is a credit. Got to skip a couple lines to make a new entry and put it on the bottom. And we sold merchandise that cost us 5.3, and we're going to expense that in an expense count called cost of goods sold. Expenses generally have debit balances. They only go up for the most part, and we're going to make it go up again by doing the same thing to it, which in this case would be another debit. So let's post that out. So we're going to go to the accounts receivable to post this, double click, go to the end of it, plus, point to the 7.4 and enter. Then we're going to go to the sales down here. Well, we can also post that receivable to the customer, which is, we sold it to Creek. So Creek down here, we sold to Creek again. So we're going to also post that here. Creek now owes us 7.4, putting us back in balance with our receivable account and our subsidiary ledger. And then we can record the sale, double click, go to the end and go to the credit. We can record cost of goods sold, double click on the cost of goods sold, go to the end of it and post a 5.3, and then the merchandise inventory. I'm going to go to the end of that and post the merchandise, making that go here. All right, the last thing we're going to do now that we have our ending trial balance, if you take a look at how that would format in terms of the financial statements, I'm going to hide these cells. So when you fill out the financial statement, we've got a balance sheet, income statement, statement of owner's equity, and the balance sheet is just the cash, the receivables, and the merchandise. Where's that coming from? It's coming from here, here, and here, and that adds up to the total assets. That's all we have in assets. Adds up to the 33.5 if we were to add them up this way, and we would say that's the 33.5. The liabilities, there are none. That's right here. The equity is not the 30,000. It's really all of this. All of this is the 33,508. Therefore, our total assets equal our equity and our liabilities. We really want to get this number though from a separate account, being the statement of owner's equity. We're going to put these numbers into the income statement. So income is just that number. And then we're going to reduce the returns and allowances. So notice that we have returns and allowances that are they are contra sales accounts, meaning they're reducing the sales account. And so what we have here in terms of total revenue is often called net revenue. So remember that net revenue is not the same thing as net income. Net revenue is net of sales. It's net sales, basically. Sales minus returns and allowances. Then we're going to take the cost of goods sold, the only expense that we're dealing with right now. We don't have any of the other vast amount of expenses. Expense is usually the longest category of stuff, but this is the most important expense. And then we're going to have another subcategory called gross profit, which is also basically the net income right now because we don't have any other expenses at this time. But if we did have other expenses, it would be gross profit and then other expenses to net income. And there's our net income here. And then that net income is part of the owner's equity. So owner's equity started at the 30. And then I'm going to say we didn't add anything more this period. That 30 was from prior periods. Then the net income is coming from here. So I'm going to represent that by making it green. And we don't have any withdrawals right now. Therefore, there's the 33,508, which is the same as this number here. So that's the number that pulls into the balance sheet. So the green areas are where these balance sheet and income statement accounts tie out to each other.